Hello, welcome to my first YouTube video. This is Sabana REIT's first half results, and I had 3 burning questions as I go through the presentation. So of course, first is interest rates. Unless you're from Mars, you should probably know that the rates are rising really fast as the Fed is raising rates to combat inflation. The second concern I had was on NAV. So if they raise rates, would the valuation drop? The third is on the AEI. So actually, the latest AEI that they did was at the NTP Plus mall when the Singapore government lifted the restrictions. I actually went down to have a look. It was quite a nice mall, I think. It's not a big mall like Causeway Point or Raffles City. Just 2 stories, quite small, but quite nicely constructed, I think. So pretty impressed. And I think it gave the REIT quite nice rental income as well from the mall. So the key highlights, DPU is up 7%. So that's quite impressive. Occupancy is now 88%. And they mentioned 2 properties. First, Tuas Avenue 4 and this Tuas Avenue 8. So for this one, they secured a 10-year master lease. So that's quite nice. Reversion is at 17%. And we'll look at this Tuas Avenue 4 later. So the DPU for the first half is at 1.59 cents. So this is the main thing that I'm concerned about actually. The impact of interest rates. So the leverage is actually quite low by Singapore REIT's standard. It's 33%. The next refi is in 24. So that's quite some time away, right? 2 years away. It's not clear though. In 2 years' time, what would be the interest rates? Is the Fed going to hike rates for the next 2 years, or are they gonna pause? In fact, a lot depends on the inflation, right? So I'm not very sure what to think about it actually. The sensitivity they calculated for you. So 20 basis points in rates rise, and the DPU goes down by 0.5%. So if you multiply by 5, so 1% interest rate rise means 2.5% DPU decrement, right? So wow, that's the impact. The valuation surprisingly is higher because I thought that with rates rising, the valuation will be lower. But maybe that's because of the AEI, I guess. Because they mentioned here, right? The uplift is by the NTP, so I guess the mall, and the new master lease at the Tuas Avenue 8, which is for 10 years, right? So I guess that's the reason. So if you look at the NAV, it's actually higher at 53 cents. So this is the 10-year master lease, Avenue 8, Tuas Avenue 8, and this is the NTP, which is quite nicely done, I think. And after they added the mall, I guess the tenants are happier because they now have more places to shop and dine. So there are talks to explore expansion space. This one is quite interesting. This is the Tuas Avenue 4. I think the current property is empty. That means it's not generating any rental income, and they're gonna essentially convert it into a higher spec warehouse. So this is the artist's impression of what it's gonna look like. It looks quite nice, right? From this one to this one. And more importantly, after they AI and redevelop the property, it will be rented out, right? So this is currently giving no rental, right? So anything better than 0 is better than 0, right? So it's targeted for completion in next year. So quite some time away. But anyway, something better than 0 is better than 0, right? Something quite surprisingly is that they highlighted the trading price performance. So this year, they're up 2% in terms of share price compared to everything which is down, right? And I did a Google on it. And it's quite true. If you compare Sabana, which is in blue, dark blue, versus Ascendas REIT in yellow, and Mapletree Logistics in light blue, this stuff is quite resilient. I'm not sure why these two guys are fallen quite a fair bit. Maybe it's because their properties overseas and the sink have strengthened, or maybe because they are in the major indexes and the funds are all uh, redeeming. So I'm not very sure, but it's quite resilient, quite impressive. So this is the final slide, and actually the main concern for me, which is the impact of rising interest rates. So you can see that it's quite nice. 75% is on fixed rates, so only 25% are floating rates, and 100% unencumbered assets. With the next debt to be refinanced in 2024, so that's 2 years away, right? So of course the main question is what the Fed will do for interest rates, right? Are they gonna keep raising all the way through for the next few years, or are they gonna finish everything in 22 or maybe early 23 and then pause, or even cut rates? Because now the market is talking about recession, so it's not clear what's gonna happen, right? And I guess all depends on inflation, right? But if you're gonna look at inflation, then it also depends on the Russian-Ukraine war, right? Is it gonna continue for a few years or what? It's all quite very difficult to predict because anything can happen, right? The Fed can raise rates continually for the next few years. They can raise rates and then cut, or they can raise rates and then pause. It's something I cannot predict. But anyway, this is the presentation and my review. If you have any comments, please leave them in the comments, and remember to subscribe and let me know any reviews. Thank you.